Good afternoon, this is Sean Golding with Golding & Golding. We're going to take a step back today and we're going to go to the very basics of how income tax works for foreign nationals living in the U.S., living outside of the U.S., but with U.S. person status, dual citizens, permanent residents, foreign nationals who meet the substantial presence test, right? So, first things first, which individuals are subject to U.S. tax and reporting? Baseline, we're only dealing with individuals, corporations, trusts, other sort of entities may operate differently. There's three main categories: U.S. citizens, lawful permanent residents, foreign nationals who meet the substantial presence test. The latter category, a lot of people get stuck in that. Common example, you're here in the United States. It doesn't have to be on a visa, but oftentimes it is a B1, B2, EB5, H1B, L1, etc., etc. And you're in the U.S. for a certain number of days over the past, in the current year and past 2 years, so it's a 3-year test. If you meet that sort of counting days test, even though you're not a U.S. citizen, even though you're not a permanent resident, you are still subject to U.S. tax on your worldwide income, and you're required to do the reporting. By reporting, we mean international information reporting forms such as the FBAR, Form 8938 for FATCA, the Foreign Account Tax Compliance Act, Forms 3520, 5471, etc. What type of income and reporting do foreign nationals have to do? Well, first of all, the U.S. taxes on worldwide income. So if you're living in the United States, if you're living abroad, as a U.S. person and your income is generated from foreign sources, you still have to report your worldwide income. Sometimes people think, oh, I've got money in a foreign country, I'm earning money in Taiwan or Ecuador, I'm also earning money in the United States, so I separate that. I report my Ecuadorian money in Ecuador, and I report my U.S. income in the United States. The U.S. doesn't do it that way. From the U.S., it's based on worldwide income, so you have to report all of your income. Earned income, so if you're an employee, if you're an independent contractor, whatever it is, if you're earning money for work that you're doing, then you have to report that. Same with passive income, and this is where it can get very complicated. Passive income categories are typically interest, dividends, capital gains, royalties, rental income, things like that. Even if it's tax-free in a foreign country, that doesn't mean that it's exempt here in the United States. Typically, a lot of Asian countries, for example, interest, capital gains, dividends may not be taxable by residents over there. That bank in your foreign country may not have updated you. They may have you as a resident, and so they're not withholding any tax. Or it could just be tax exempt. It's a type of income that's not taxable in the foreign country. From a U.S. perspective, the income is typically taxable, so it doesn't really matter if you can escape tax overseas. From a U.S. perspective, you still have to report it. Now, you may have foreign tax credits available to offset your U.S. tax liability. From a baseline perspective, worldwide income, it includes earned income, it includes passive income. That's true even if you don't net a profit. For example, you have rental property, maybe between depreciation and expenses, deductions, you come out behind, not ahead, right? You still have to report all of that on Schedule E on your U.S. tax return. Now, in addition to the income, there's the complication of reporting. Reporting, as we mentioned earlier, is about having to file international reporting forms to disclose certain assets you may have overseas: foreign bank accounts, savings accounts, current accounts, investment accounts, stock accounts, mutual fund accounts, ETF accounts, things like that. It also includes stock that you may own, businesses, foreign trusts, all of that. It's all reportable. You may have to report the same asset on many different forms. You may have to report the same asset differently on different forms. For example, you may have an investment account. It's got $200,000 of foreign mutual funds. You have 15 mutual funds in there. For the FBAR, you may only have to report the actual account because it's all within a single account. When it gets to the tax return, you have to, because they're typically PFICs, passive foreign investment companies, for Form 8621 purposes, you may have to file separate 8621 forms for each one of those assets, so it can get very complicated. There are ways to minimize U.S. taxes. There are ways to eliminate U.S. taxes. Not everybody qualifies for every strategy. First, the person may be able to make a treaty election. Let's say you're a permanent resident, you live overseas, you live there most of the time, and you're in a treaty country, of course. you may be able to elect to be treated as a foreign person for U.S. tax purposes, so that you're filing a 1040 NR instead of a 1040, and only being taxed on your U.S. sourced income, not your worldwide income. A couple of more common ways that people can do it is if there's foreign tax credits. Let's say you earned income in a foreign country, you pay tax in that foreign country, you report the gross income, not the net, on your U.S. tax return, as well as the amount of taxes you paid, depending on what your tax liability is in the United States. Maybe you paid the exact same amount. It rarely happens, but it could happen. Or you paid more in the foreign country so that you can carry those credits forward to another year to be used on foreign income, or you paid less in the foreign country than you would have paid in the U.S., and so you still owe some U.S. tax. There's also something called the foreign earned income exclusion in housing, and basically what that says is if you live overseas and you meet the tax home test in either, not both, either the bona fide residence test or the physical presence test, you can exclude upwards of $110,000 a year plus housing. So for a couple living overseas making $250,000 and they both qualify for the foreign earned income exclusion and the housing, even though they can't double dip, they may get away without having to pay any U.S. tax. It typically helps in a situation in which it's a low tax or no tax country. Like I said, you can't double dip, so you can't take the same dollar and use it for both, but depending on how much income you earn, if you're a high income earner, you may be able to use foreign tax credits and foreign earned income on the same category of income. If you're out of compliance, there are various ways to get into compliance, and they're safe. They're approved by the IRS. Please try to avoid the quiet disclosure, avoid any attorneys or practitioners who are just claiming to be experts and then trying to sell you on doing VDP if you're non-willful, or quiet disclosure. The main programs are voluntary disclosure program, which is VDP. It's for people who are willful or cannot certify under penalty of perjury that they're non-willful. Back in the day, people did OVDP, even if they were non-willful, because you can avoid an audit and the penalty wasn't as bad. But these days, you would only do VDP if you were willful. If you're non-willful, there's many other programs available. Streamlined filing compliance procedures, a different program depending on whether you live in the U.S. or you live abroad. It's streamlined domestic versus streamlined foreign. There's also delinquency procedures and reasonable cause. We have a ton of free information available on our main website and our sub-websites. You can always reach out and schedule a reduced fee initial consultation if you think it's appropriate to your matter. It's something that we handle here. Again, my name is Sean Golding with Golding & Golding. Thank you for your time. Enjoy the rest of your day.